We have a new Fed chair nominee who's already moving markets. Gold just had its worst day in months, and traditional software stocks are being disrupted by AI. Hi, everyone. I'm Christos, co-founder of Caplytica, where our goal is to give you the tools and knowledge to turn investing into a shared skill. By the end of this video, you'll understand why gold crashed, what the Fed is really signaling, and which tech stocks are in trouble. This tech sell-off might be more important than most people realize because it could shift how investors actually think about the sector. I'll get into that a little bit later. Let's dive in. All right, let's start with the biggest news. President Trump just named Kevin Warsh as his pick to replace Jerome Powell as Federal Reserve Chair. Now, if that name doesn't ring a bell, here's what you need to know. Warsh was Fed governor during the 2008 financial crisis. He's got Wall Street credibility, and crucially, markets seem to trust him. Now, why would precious metals crash on a Fed chair nomination? Because the market was worried Trump would pick someone who would just do whatever he wanted, cutting rates on command, printing money, basically turning the Fed into a political tool. Warsh isn't that guy. He's seen as independent, credible, someone who'll make decisions based on economic data, not tweets. For people holding gold or silver as a hedge against Fed chaos or runaway inflation, this is a narrative shift. The Fed is going to lose independence thesis just got weaker, and that's reflected in the price action. For equities, an independent Fed chair who makes decisions based on economic data rather than political pressure is generally seen as a positive for the long-term market stability, even if it means less monetary stimulus in the short term. But here's the thing to watch: the Senate confirmation process. If Warsh shows any signs during hearings that he'd cave to political pressure, the whole narrative could reverse. That would likely send gold back up and introduce uncertainty into the equity markets. Speaking of the Fed, they met last week and kept interest rates exactly where they are. No surprise there, but here's what caught my attention in their statement. They actually sounded more optimistic about the economy. Now, normally you'd think that's good news, but here's the problem. Inflation is currently at 2.8% based on the Fed's preferred PCE measure. Their target, 2%. We're not just above the target, we're actually moving away from it. This matters because it means rate cuts are basically off the table for now. If you're hoping for lower mortgage rates, lower car loans, or stocks to get a boost from easier monetary policy, that's not happening anytime soon. The big question is whether inflation will come down on its own or whether the next Fed chair will need to take aggressive action later this year. All right, now let's talk about what's happening in tech, because this is important if you own any tech stocks. Traditional software stocks are having a rough go of it. The iShares software ETF had its worst single-day decline since April, and ServiceNow, one of the big enterprise software names, dropped 10% in a single session. Remember when I said this could change how we view the tech sector? The headline frames this as AI fears crush tech, but that's not quite right. What we're actually seeing is the market doing something it hasn't done in years, actively differentiating within the tech sector. It's not punishing tech broadly, it's drawing a line between companies it sees as AI native and companies it views as potentially disrupted. That distinction matters because it signals a shift in how the market is thinking about technology as an investment, not as one monolithic trade anymore, but as a sector with clear winners and losers emerging in real time. Investors are getting increasingly worried that artificial intelligence is going to disrupt traditional software business models. The fear is that companies who've built their empires on subscription software like ServiceNow, Salesforce, and Adobe might get displaced by newer AI native companies. Think about it this way. There's a big difference between a company that adds AI features to an existing product versus a company that's built from the ground up around AI. The first type is playing defense. The second type is the future. And this actually connects back to Kevin Warsh. He's made comments suggesting that AI-driven productivity gains could fundamentally change the inflation equation. His argument? If AI makes businesses significantly more productive, doing more with less, that's inherently deflationary. Companies can produce more goods and services without proportionally increasing costs. If Warsh is right, and AI delivers real productivity gains across the economy, it could give the Fed room to cut rates without triggering inflation. That's a very different playbook than what we've seen from the Fed over the past few years. So when we look at what's happening in tech right now, keep that in mind because the AI story isn't just about individual stocks. It could reshape the macro environment. Moving forward, we're watching out for how the Warsh confirmation unfolds. more earnings rolling in, and any new inflation data that could shift this picture. And if you're wondering how to position your portfolio going into 2026, check out our video on 5 moves to consider. Subscribe if you want to stay in the loop. We'll see you in the next one.